The pinning effect refers to a market phenomenon where the price of an underlying asset gravitates towards a specific strike price or stays within a narrow trading range. This effect is often associated with high gamma levels in the market and is a result of dealers delta hedging their position. We see this in two environments: positive gamma markets, which more or less means a call-dominated market, and in the final week of a monthly options expiration cycle. Before we proceed, let's cover some basics. Gamma is the change in an options delta per a 1-point move in the underlying. Gamma is the highest for at-the-money options. And from a modeling perspective, calls have positive gamma and puts have negative gamma. Strikes with larger gamma values or balanced gamma exert the most influence. You can determine potential pins by analyzing gamma data, charts, or if you're a member of Zero DTE traders, simply refer to our key metrics or butterfly table in the daily market report. What you are looking for are strikes that are high in absolute gamma, so calls plus puts, or strikes that are fairly balanced, calls to puts. The strikes with the strongest magnetic effect is known as the absolute gamma strike, and that is marked on our key metrics table, as well as other strikes that could exhibit a pinning potential. This is an example of SPY gamma distribution, mid-OPEX cycle. So we have positive gamma in green, negative gamma in red, and this is broken down on a per strike basis. The standout strike is 455. This is designated our absolute gamma strike, meaning it has the highest total gamma calls plus puts, and therefore the strongest magnetic effect. Here is an example of the SPX gamma distribution on the day of option expiration. You can see how pronounced this strike and magnetic effect becomes as you near the expiration date. Now, I understand these are different products and different expiration cycles. I'm simply illustrating the potential change and influence as a cycle nears expiration. So why does this work? If you buy or sell an option in the market, there's a good chance that a dealer, also known as a market maker, is on the other side of that trade. Market makers are not in the business of speculation. Therefore, they hedge their position via buying or selling futures and continuously have to adjust their position to maintain delta neutral. This increase in market gamma prompts more active dealer hedging, compelling dealers to buy into weakness and to sell into strength in order to minimize risk and rebalance their book. This activity drives the underlying asset back towards a specific strike or zone. And this hedging activity becomes more and more dominant as we approach the monthly option expiration, which is the third Friday of every month. This is because the Greeks associated with these options become more and more sensitive as expiration approaches. We've witnessed this play out for many sessions now around SPY 455. Dealers are buyers below, dealers are sellers above, creating that mean reversion pinning effect. And we've most certainly seen several closes at or around 455. Now, eventually the market's going to break away. But when you see conditions like this, it generally requires some sort of catalyst, whether that be economic data, Fed speak, or just the option expiration itself. But the markets will make attempt to break out. But if there is not enough buy or sell flows one way or the other, to counteract the dealer hedging, it's going to get pulled back in. And we just seen this for many, many sessions now. But finally, on Friday, we did break away and we moved up and closed at 4,600. What was interesting here is that the gamma data gave us indication that this pin was shifting. And this occurred on Thursday or via the Thursday data. So when we opened the market on Friday, we were looking at 4060 as the potential pin. So in other words, this was the absolute gamma strike, not 455. And well, we closed right on that on Friday, more or less. And this is just aftermarket. So there's a lot of edge looking at this data. You can determine where the market may gravitate towards, where the market may pin. and play reversion to, a butterfly at, or an iron condor around these dominant strikes. Now, of course, the pinning effect isn't a guaranteed outcome, and it may not occur in every situation or in every market. However, when it is in play, there is substantial edge. If you want to learn a little bit more about the underlying dynamic, that delta hedging, there's a video linked in the description. If you want to become a member, get access to this data, our trade ideas, and a very helpful community, you can visit our website at 0dtetraders.com.